I'm in. I was in Metro Atlanta. I'm in Chattanooga, Tennessee now.
Oh, nice, nice.
Chattanooga, Tennessee is a tax-free state. We moved here late last year, so we're retired for the. I'm finally retired for the first time in many years. I tried to retire and it just didn't work. I just kept finding things to do.
Yep. It's funny. I should have probably mentioned that I took earlier retirement from the Fed, like I said, 5 years ago, almost 5 years ago now, and I was asked to help out a company, so they put me on a retainer the last 4 years. I really haven't done a whole lot for them, but I basically helped them. I helped them with the cannabis industry. I helped them find banks to bank the cannabis industry because I was actually the first regulator in the country that had to deal with that mess. So anyway, I was getting paid doing that, and in my spare time, I started learning more about options.
Great. That's
Well,
very good. Sandy, are you back?
yeah, I'm back. Just recording. Just
Great.
feel like there's got a little tech issue, but I think we'll be okay. I just really want to thank Richie for being here today and to kind of explain how he actually manages his own portfolio. And for anyone that's retired or you're in the process and you've had investments, you know how daunting that could be. Sometimes just to make a decision on what fund you want to get into and then change it around, it seems to be, it takes all of our energy. So for me, I know that, managing a portfolio, I think would be very difficult. So I'm very anxious to find out, the steps that a person takes in order to do that. So Richie, how would you describe your process into options? Like what brought you to options, and then why choose the strategies of generating income versus the typical option plays?
Yeah, that's a great question. Well, when I did take that early retirement and I got off that retainer, I realized that I needed to bring in income to basically pay the bills and living expenses. And I tried, the day trading. I tried different things with equities, not day trading with options like what I think you are doing. But reading the charts, all of that, I got really proficient, I think, in reading the charts and knowing how to do that. But what I found was that I would have a great week or a month or 2 months, and then the next week or month, I'd wipe all of those gains away. And so, what I realized for me anyway, selling premium, so never really a buyer of options, was a better strategy for me because of the size of my account on the one hand, and on the other, I felt like I had a better opportunity to generate income and not have these large drawdowns at times. And so my strategy is really built around looking at the premium that you receive, almost like someone that owns an individual stock or an ETF, and they're receiving a dividend payment from that. So I look at the premium that I receive from the options I sell as almost like a dividend payment. And so that's why I got into it. I really found like it was the best strategy to generate income to pay your bills.
And you could clearly see when you got into actually performing all of the steps, and, why did you choose the wheel strategy, or what strategy are you using and why did you choose that one?
Yeah, no, that's a great question, and maybe I thought, Sandy, I would let people know that in my IRAs or in my retirement accounts, I rolled over from the Fed my 401k into IRAs, and I honestly saw last September that the Fed was going to be tightening. I actually had the opportunity at Kansas City Fed to sit on the open market committee discussion, so I learned a lot about that. But the reason why I bring that up is I literally started taking all the gains I had in my mutual funds because the stock market, as we know, was at all-time highs, right?
Mm-hmm.
So I started taking all of that and putting that in cash. And the reason why I did that was I knew that the Fed was going to tighten and we were going to have a pullback. I was pretty sure of that. And I wanted to position my portfolio because I am a passive dividend investor. So I want to own individual stocks and individual ETFs that are going to pay me monthly income or quarterly so that I can basically live on, pay the bill, so to speak. So I put all that money in cash, and I chose the wheel strategy because I was looking at selling cash secured puts on individual stocks and ETFs that I identified that I wanted to own long term. And the way I determined what prices to get in was based on the individual stocks, fair market estimate, looking at charts, looking at support levels. And then what I liked about it is you could literally sell a cash secured put and get paid to own a stock that you want to own long term anyway. And then once you do get assigned the stock, then you can turn around and not only receive the dividend payment from owning the stock, you could sell covered calls to enhance that overall yield and return. So I felt like doing the wheel strategy, at least in my retirement accounts, was the best strategy for me to generate the income that I needed to live.
You know, a lot.
So I hope that
Yeah,
helped.
no, it totally does. I was just thinking, when I first heard about the wheel strategy and how, well, everyone knows, Warren Buffett, I mean, that's how he,
Yep.
buys his stocks, right? A lot of people really
That's
don't,
exactly right.
yeah, people don't understand, I don't think, the mechanics of being assigned a stock. Can you kind of walk us through that?
Yes, I will. So I typically sell, at least in my retirement accounts, I will typically, particularly in this market, I will sell a cash secured put typically 30 to 45 days out. And so what I will do is I will, when I make that decision of this is the price I want to own the stock in, kind of like what you were saying with Warren Buffett, I'm gonna leave it alone. I don't need to manage it because I have determined that I want to own this stock at that price. So what happens is if the stock price falls below your strike price by expiration date, then you are required, because you're basically acted as the insurance company. You told someone that you would buy the shares from them if the price of the stock reached that strike price. And so then those shares, you are assigned those shares. So you're going to be the buyer. You still one option contract. You're going to be a buyer of 100 shares at that strike price. So I hope that answered your question.
It does. Thank you. And then and you do that on purpose to get the lowest price possible. And if you don't get the shares, then you're getting the premium that you've collected from selling that cash secured put.
Exactly.
Okay.
That's exactly right. And that's why it's a great strategy, because I can tell you, for someone that's been doing this for a while now, your mindset completely changes when you're selling options on stocks and ETFs that you are comfortable with and you want to own. I am literally right now, I've only been assigned, think about this, the market has pulled back significantly, and I've only been assigned 2 times. And in the meantime, over the last 5 months, I've been able to generate a very nice annual return if I was to analyze those returns by receiving that premium that you mentioned. So, it's just as a sidebar to make sure that I'm investing and getting vested and owning the shares of companies I want to, I am in some cases directly buying the shares. I'm doing it dollar cost average wise.
Mm-hmm.
I'm not lump summing, but I got to make sure that I get invested. And then sometimes when you're selling cash secured puts, the risk is you will not get assigned. But maybe saying this would be a good time to mention that I will sometimes sell at the money. And what that means is that, like for instance, I might want to own I just did this on 3M. I want to own 3M. It's at $148.
Mm-hmm.
And I want to get in it because looking at the chart and the fair value estimate of 3M, I believe it's at a good price right now. And so I sold a put at 145. That's pretty close to being at the money.
Mm-hmm.
So I have a better chance of getting assigned that stock because I didn't go way out of the money like 130 or a 135 or a 140 strike price. So that's one way that you can guarantee that you get assigned is you can sell at the money, and you get more premium that way.
So for the people that really don't want to own stock, but they actually just want to earn that premium. When we talk about like a selling a cash secured put versus just selling a naked put, what are the two differences there?
Yeah, that's a great question. And so in my retirement accounts, we're talking about cash secured puts because I have enough cash on hand to actually have the ability to buy the stock with my cash. Okay. Now, in my margin accounts, I do not do the wheel. I don't want to own the stocks. Mm-hmm. So your question is very appropriate. I sell a lot of naked puts. And what that really means, and if you Google it or if you talk to people, you might come up with little different definitions. Some people will tell you that a naked put means that you don't have a spread on, you're not protected with another put, or that you don't have sufficient buying power. And that's not really the way I would define it. A naked the reason why I define it as a naked put is because it's in my margin account, and the broker is only going to require a certain amount of capital against that trade you put on. So it's very important that you keep track of how much puts you have sold out there, because the notional value can be quite significant. So really what a naked put means is that you're selling in a margin account, and the broker is not requiring you to put up the full amount to buy the stock, if that makes sense.
It does. It does make sense. And then if for those of us that don't have, or let's see, a lot of traders don't have a margin account. They're just not used to, having that type of account because they've heard that, you're basically borrowing money, even though that's, not the case. But if you wanted to, could you kind of describe, like, if you were kind of nervous about selling a naked put, how you could go about earning premium without having to sell the naked put? And then the other question, I guess, to back that up was this question in regards to a cash secured put is just in a regular cash account. Is that correct?
Yes, but like I said, a lot of people will view, like, I'll give you an example. Okay. If you put $100,000 into a margin account, mm-hmm. and you sell puts on stocks that, if you got assigned would never exceed $100,000, you could, in theory, say that's cash secured because you're using your own cash to secure it, right?
Got it.
So yes, actually, cash secured could be in a retirement account or a margin account. Again, depending on how you use your margin. Where people get in trouble, and maybe this is where your question is going, is that when you sell puts to the point where if you got assigned, you would not have enough buying power, right, to buy the stock. So the stock falls below a strike price, and you don't have sufficient buying power, either from your cash or even what the broker is going to loan you, mm-hmm. and you're going to get a margin call. And so that's the danger. And there are folks that I know personally that have done that. And so what I would recommend, if you have a no assignment strategy like I do in my margin accounts, what I do is I sell at what's called a 10 or 15 delta. And Delta, and I'm sure maybe Sandy's mentioned this, Delta measures how much an options price can be expected to move for every $1 change in price of the stock or the ETF. Or put another way, really, if you're selling at a 10 or 15 Delta, what that means is you have an 85 to 90% chance or probability that that price of the stock will not fall to your strike price at the time you put the trade on. So every short put I sell, I have a 85 to 90% chance that my strike price won't even be challenged. So that's one way someone can look at selling short puts in an options in a margin account and being safer, going way out of the money. And then, Sandy, I'll stop there, see if you have any other follow-ups, and then I can talk about how you can manage from there too, if you want.
Well, when we talk about these high probability trades, and they are very high probability trades, what is what's the downfall of that? Is there a difference between the risk versus the reward?
Yeah, there can be, because you're not getting enough maybe premium because you're going so out of the money. I guess a lot of people will say it's not worth it to me to sell at a 10 or 15% delta when I'm only maybe achieving a 6% return on cash, and then maybe it's 30% on margin. That isn't enough for me to risk, because in theory, right, Sandy, if you're selling premium on a stock and it goes to zero, you're risking that entire capital for very little premium. So that's the down draw of high probability of profit. But I feel personally more comfortable receiving less premium and doing more trades. And quite honestly, in this market, when the market's pulling back, the VIX is high, and you can receive a lot more premium because the VIX is high. So as an option seller, that's actually a benefit.
Okay, so Richie, I have a question. One of our viewers, I think you've answered the question, but the question was if you use the sold option delta, which or only price, or is it a combination of things?
It's a combination of things. That's a great question. I'm glad that was asked. So while I do look at a 10 or 15 delta, I will also look at a daily chart, and I will look out, because I'm selling typically 30 to 45 days, I will go out and look potentially for support levels. And believe it or not, what I have found is that I typically find support or even below support. So to get really safe with your strike prices, that 15, 10 delta is basically right there at support in many instances. Sometimes it's not. Sometimes the support level's higher, and so you could sell at a 20 or 25 or 30 delta, because there appears to be pretty good support levels there. So I look at the charts. I hope I'm answering the question. I look at the charts, and I try to find psychological levels of support.
Okay, and that so just as a reminder to everyone else that is watching, just type in the Ask Sandy channel and any questions. And then the next question is, let's just say there is a dip and you're in the red. Do you sweat it out, or do you roll it, or how do you handle that?
That's a great question.
That was good where I was going to go. So the one thing with this strategy in my margin account, I'm not looking to put on a stop loss or to exit a trade. And let me tell you why. I only sell options on quality companies or the indexes, and I primarily do the indexes. So you're familiar probably with SPY, which is the S&P 500 ETF. It is by far the most liquid traded ETF with regard to options. So why I mention that is I am confident that when I sell a put option on the S&P 500 or the Dow Jones Industrial Average ETF, DIA, that I can roll and know that at some point the market's going to come back. And so what I do is if the stock moves completely against me, and I have an example of that happening to me this past week, I will roll for a net credit and collect in many instances more credit than I did when I initially put the trade on. And I will roll down and out. And what that means is I will lower the strike price and I will roll out further in time. So I might go out another week or 2 weeks. Sometimes it's a month, as long as the net credit makes sense to do that. But that is why I really like this strategy, this no assignment strategy. And I almost view that premium like a dividend payment. I am receiving credit and premium every time I put on a trade and when I roll a trade. And so I hope that answers your question.
Yeah.
I think so. If not, someone will come in the chat box and let me know if you need further clarification.
In fact, I could give a quick example, maybe like last week, if this is helpful. I put on, it looks like it was on May 5th, I put on a 400 strike price SPY short put, and I collected $183. Well, we all know where the SPY is right now. The SPY moved against me almost immediately. So I rolled, and what that means, by the way, is I bought back the option I sold at 400, and then I sold another one, and the difference between that resulted in a net credit of $231. So I collected $183, then I collected $231, and I rolled that SPY trade from 400 to 380 and out 2 weeks. And then it kept falling, and I rolled again on May 9th and collected $208. And now my SPY is at 360, and it's out to July. And I've collected $622 now on that trade. And so, and I feel safe, right? I mean, the SPY, I'm at 360.
Right.
So that's the power of rolling. But it's extremely important that you do it on quality companies and, in my personal opinion, the indexes. There's 500 companies in the S&P 500. And I feel comfortable that I could roll and know that at some point the SPY is going to come back.
So you're not recommending doing this for any type of tech stock, is that correct?
Oh, gosh, no. I do not sell short puts on growth stocks, particularly in this market. Don't do it.
That's
I only
good
choose
clarification.
blue chip value stocks or the indexes. Yep.
Yeah, that's good clarification. And then I just wanted to clarify as well, when someone rolls their position, it sounds, somewhat complicated, but you're really just closing that position and then reestablishing a new position. But in doing so,
That's
you're
right.
getting a credit. And so sometimes that's confusing for newer people that are not used to that term rolling. But in Thinkorswim, there's an option to do it all at one time so that it's convenient versus closing one and then opening up another. So just so you know that's what it means. And then have you ever really, because I am a kind of a scaredy cat when it comes to the naked options, just based on, of course, the way that I was just trained in my education in it. Does, I used to be a credit spread seller, and I'm just wondering if, is that an option for the people that have a margin account? They don't necessarily, of course, want to use that margin that's available, but want to receive credit and still be protected. Do you think that
Absolutely.
that's still a good strategy, I guess, to use for the same type of
Yes,
companies that you're using?
Yes, absolutely, Sam. I'm sorry, I didn't mean to interrupt you there.
No,
Yes,
okay.
I'm glad you brought that up. You can put on a credit put spread, for example, and that's a defined risk strategy, right? Because you could sell a put, say at 400 on the SPY, and you could have bought a put at 395, and you would have a $5 wide $500 at risk, right?
Right.
Difference between 400 and 395 is $5 times 100. That's $500. What I have found, though, in my experience with spreads, is that you have to get closer to the sun, as I like to call it, closer to the current price of the stock to really generate, in my personal opinion, the premium that you would need. The other con to it, in my opinion, is it's harder to roll. They're harder to manage. But to your point, for those that have smaller account sizes or that don't feel comfortable being naked, because there's downside risk there, you could put on a spread and limit the risk, and then having smaller accounts, sometimes putting on spreads makes a lot of sense. I'll tell you real quick what a really good stock potentially to sell a spread on, because you can get really safe and get far away from it. I'm not necessarily recommending this, but I'm just saying people will do it all the time on this stock. It's Tesla, because you can go 30% away from the stock and put on a spread and actually generate pretty good premium. I personally don't feel comfortable selling puts on Tesla, but I know a lot of people do.
Now I noticed that you're when we're talking, it's primarily the selling of puts. Is there a reason why you don't sell calls?
Yes, I will only sell a covered call, which means I own the stock. It's the safest strategy, and it's the easiest one to put on and to manage, is the covered call strategy. So you own the individual stock, you're selling a covered call. I do that all the time, but selling a naked call, I will not do it. And I have done it in the past, but I can honestly say stocks can go to zero, but they can go to up forever, right? And particularly in this market. I mean, would you feel comfortable selling a naked call, say like on the SPY, if at say 410, and then the next day you wake up and the SPY's at 440? I mean, that's naked calls to me are the most risky strategy you can do, and so I will not do that. And if I do put on a call, I will do a spread with that to protect myself.
All right, so Richie, one comment and then a question. So you've really researched this to the point for risk management is a huge factor, and that it's not about how much money you make, but how much money you can make without losing money.
Exactly. That's why I can honestly say this. I've had very few losses being a seller of premium. And it's because you can get safe, like we've talked about. And the other thing that I like about it is that I only do one contract. We haven't talked about that, but you mentioned risk management, and putting on only one contract means that if the stock moved against you or the index moved against you, you could potentially put on another one and build out a position with regard to your position size. So if you have a $30,000 account, you'd want to only have 2 or 3 positions in there doing that. But you could then add on contracts to manage if a stock went against you. So that's another advantage, in my opinion, on watching your position sizing and only doing one contract initially.
Okay, so the question that came next, actually there's 2 questions. I think you can answer it all in one comment. What is the trigger to roll? And then how much time do you actually spend on your portfolio management?
Yep. So rolling, and that I'm glad that was brought up, because I don't think I mentioned this. So it's always better to roll before your strike price is breached. So, like I'll go back to that example. Real life examples are the best. That SPY that I put on, almost immediately the SPY reversed In fact, I think there was something that popped up in this Discord that said reversal, 1 hour reversal. So I started looking, and sure enough, the SPY had come back, and it was at 410. I put it on, it was at 420. It got down to 410, and I was at 400. The minute it got to 410, I rolled. And so you want to roll typically 7 to 10 days before your expiration, or if you're reasonably close to the price of the stock breaching your strike price. I don't like to roll in the money. I don't, because it's more difficult to do that. So try to roll before your strike price is breached. That's extremely important, or within 7 to 10 days of expiration. The other question about time management. I have a pretty large portfolio, so I'm doing my retirement accounts and my margin accounts, and it is a lot of work. But now that I have everything set up in an Excel spreadsheet, and I have a journal where I document all my trades, it isn't maybe as bad as maybe what you're thinking. It's probably a 2-hour deal every day that I'm managing, and just to make sure that that I'm not missing anything.
Okay. That's helpful.
That is very helpful.
One other question that popped up, and I think this is in maybe the S&P 100, but someone asked a question about Coke, KO. So I'm assuming that would be a safe company for you.
Yes, in fact, Coke is a fantastic one. In fact, I was going to mention Coca-Cola, Pepsi, Walmart, McDonald's, Home Depot, Caterpillar, really consumer staples type individual stocks. Those are the ones, value blue chip stocks, and again, the indexes, the Dow Jones Industrial Average, the DIA, and then the SPY are very good. I also wanted to mention, I told Sandy I was going to mention this, because the SPY, as great as it is, I think it's the best index to sell options on, but it's at 400, right, or 395, wherever it is right now. Mm-hmm. It's pretty high in price. There's also another ETF that tracks the S&P 500 that folks trade options on, and it's called SPLG, and it's at $46. So if you wanted to sell options on the S&P 500, you could choose that ETF, which is lower in price.
That's interesting.
Yeah, that's great info.
A lot of positive feedback. People who like what's going on here.
Oh, that's wonderful. Well, I have to say that it was it's the members in our group that are giving us these suggestions, and we're just taking them and running with them, and hopefully, turn this into something that is very useful for the membership. And Richie, you gave me a picture to put up on the screen, and I'm wondering, what is this pyramid? What is it showing me?
Yes, and you have it up right now?
I do.
God, I don't know why I don't see it. There's something wrong with me.
Does Jay, do you see it?
We do.
Okay. Oh, so
all right. Wow.
Just click on maybe mine, where click on my name, where it says live stream, maybe.
Yeah, I see it now.
Okay.
Sorry about that.
Yeah,
so this is really, in my humble opinion, a great way to look about planning for retirement, or really even if you're younger. At really any stage. But I think as you get older and you start to approach retirement age, mm-hmm. this pyramid will really help you kind of determine how you want to allocate your portfolio. And so I'd mentioned I'm building out my long-term portfolio, and I'm a passive dividend investor. I want to live off the dividend and the income. And what this pyramid is showing you, at the very bottom, the growth phase, those are growth holdings. So you might recognize VU, which is basically the S&P 500 from the Vanguard, mm-hmm. and and it's very low expenses. So all those are growth holdings, ETFs, and then the next level up, you have growth and dividend ETFs. And one of the best ones there is SCHD. It's a Charles Schwab ETF. It's actually almost outperformed the S&P 500, and it pays a 2.89% annual dividend. And then as you go up the pyramid, you start getting into income-related covered call ETFs. And at the very top there, you have QYLD, RYLD, and those are just income ETFs where you have the fund manager that owns an index like the NASDAQ or the S&P 500 or the Dow Jones Industrial Average, and they're selling covered calls on your behalf, and they're providing you a monthly distribution of income.
I have never heard of this.
And some of these returns are quite extraordinary. Now, the one thing I will say for covered call funds is they are not going to have the capital appreciation than a growth fund. So they're designed for income. QYLD pays 11.5%, 12% annual distribution. And so just for people's record, what I plan on doing is I'm primarily growth and dividend, individual stocks, and then I'm going to sell covered calls on those. But I also am going to own JEPI in here and Devo, and I do own those. And they're going to pay me monthly income, and they're going to be doing covered call strategies for me on my behalf, and I'm going to collect the income from it. But the point is, with this, as the younger you are, in my opinion, you want to be more in growth. And as you get closer to retirement, you want to start thinking about dividend and income for sure.
So those two that are on the top, is that a OYLO? Is that correct?
No, it's called QYLD. Oh. It is probably the most popular income ETF out there.
Really?
Extremely popular.
And then the other one is RYLO?
Yes, okay. That's RYLD.
Oh,
QYLD is a covered call ETF on the NASDAQ, and the RYLD is the Russell 2000. Huh. And XYLD is the S&P 500 covered call ETF.
Well, you just taught me a whole bunch of stuff I never even knew. I mean, that is so interesting.
So one comment that came up about selling a put and have to in a margin account, and the interest rate, you have to really see what's going on to make sure your ROI is greater than your interest rate?
I think someone's referring to margin interest. Is believe it or not, when you sell options, you don't have to pay they're non-marginable. So the only time you have to worry about margin interest, I think this is the question, is when you get assignment of stocks. If you own stocks and the market moves against you, that's when you start paying margin interest. But if you don't get assigned, you don't have to worry about margin interest in a margin account when you sell options.
As well as if you have, the amount of money in your account that covers the actual purchase of that stock, if you were assigned, then you still don't have to use that margin. It's almost like a fail-safe. They require it, but you don't have to use it. It's like a line of credit in some weird way.
I can tell you, and Sandy, don't get mad at me. I'm not suggesting people do this, but believe it or not, if you have $100,000, you put $100,000 into a margin account. That's your cash, $100,000. Mm-hmm. They're going to give you another $100,000, so you're going to actually have $200,000 in stock buying power. And as long as your notional value doesn't exceed $200,000, mm-hmm. you really should be okay. But I would not necessarily suggest that because you're really pushing the envelope if the market pulled back in that scenario. So I typically split the difference. I won't, in that case, if I put $100,000 in, I would never have my notional value above $150,000, if that makes sense. That gives me a lot more cushion. And so I don't know if that made sense. I hope it did, but You're right. You don't. If, as long as you have the buying power, you don't have to worry about margin interest or getting a margin call.
Okay, we have one more comment. Yeah, Nick says, if I remember correctly, you mentioned that you only had 2 assignments or losses. What caused these compared to the others that were not, and were they a surprise?
No, they weren't. So the two assignments were purposeful. They were in my retirement accounts. I was like, please let me get assigned. I want to own these. So they were not surprises. I basically sold at the money to get them to get the stock assigned. Now you might want to ask, well, Richie, you want to build out your portfolio. Why are you not selling everything at the money and getting assigned? Well, based on my analysis, looking at the fair value estimate, looking at the charts, I'm going to be very thoughtful about entering into long-term positions. I'll just give you a quick example on Home Depot. I think Home Depot, if you look at Home Depot and how it's performed to the S&P 500 since 1995, it's not even close. Home Depot has blown it out of the water. It's an incredible investment. It pays a dividend, but I don't want to own Home Depot unless it falls to $275 based on my analysis. And right now, I believe Home Depot is, like around 290. When I put it on, it was at 300. So I think that answers the question. I'm still going to be very thoughtful and careful about what prices I choose. But in those examples with the assignment, I was not surprised. I actually was wanting to get assigned those.
Okay, and I have some people writing in all caps that they would like to have a copy of that pyramid. So I'm thinking that maybe I can really get some money out of this.
Yeah,
I got a screenshot. I'll
Yeah.
I can post that somewhere. Rich and I were discussing we'll probably have a channel for this type of information, and I was going to ask you, Rich. I mean, as I'm collecting the information to put on a channel for the members, would you be willing, I guess, weekly to kind of, give us some choices of, maybe not choices, but, maybe some alerts that you're doing so that we can kind of follow along and paper trade them and, study them while we're getting used to those types of strategies to see, would this be something that, we could do and enjoy, maybe this. I'm always telling members, like, there's so many different ways in the market that you can make money. The hardest thing is to find which one, is good for you and that you do well at. And once you find that, then you just perfect it and get better at it. And that's exactly what you've done, it sounds like. And it sounds like you're doing a great job. And I really appreciate you being here. Would you be willing to kind of walk us through some of your picks, each week as we learn together?
Yeah, absolutely. I would be willing to do whatever you feel it would be helpful. I think create another channel. I could put, if it was of interest, I could put stuff out there not only on options and what I'm doing with. I could put all my trades out there. I could even identify what I think are safer stocks. I could even put out information on this pyramid. I could put out information on ETFs and maybe some of the, information around who it might be best for. And Sandy, I'm kind of glad you said that it's really important to find a strategy that works for you because, I'm not here to say this is the only way to do it. I'm always leery of people that say that. And you got to find what works best for you. But I would be more than willing to help out and to help people understand dividend investing, covered call income, the wheel, whatever you think would be helpful.
That sounds great. And just a caveat, just a kind of a disclosure that, none of us here are financial advisors. This is for education and entertainment. And, anything that we put in our channels, you'll have to do due diligence with. But I certainly, would hope that, you'll utilize your platform, get used to it, and then paper trade some of these ideas and see if this is something of interest to you. I think it's fabulous. In fact, I've learned so much today, and I'm keeping a screenshot of that pyramid as well. So I'm going to look into that right away.
I think we're getting a lot of positive feedback from people on those last comments. They really, in fact, KS, this is being recorded. Big Boom, it is being recorded. So
Yes.
A lot of people want to be able to listen to this all over again. So,
Absolutely, and this won't be the first time. We're just doing an introduction right now of these types of strategies, and I can definitely see us, moving forward with like maybe little, lesson plans, so to speak, and just to get you familiarized with this type of strategy.
Okay, I have a two-part thing here. Number one is, do you recommend certain brokers? And then you can just kind of segue into this next part. Sandy mentioned credit spreads and debit spreads earlier. For someone with a small account, that's a retirement account that's not necessarily a margin account, could they, instead of selling put, could they put on a debit spread or credit spread and get income that way?
Yeah, absolutely. I didn't know if that was for Sandy or me, but yeah, absolutely. In fact, I've done spreads in my retirement accounts. Yes.
Okay. Do you recommend a broker or a broker?
You know what? I think there's a lot of good brokers out there. I think it really depends on your investment strategy and style and what you're doing. For me personally, I like that the fact that I have a broker where I can call 24 hours, 7 days. They actually, because I got portfolio margin, we didn't talk about that. We don't need to, but I have portfolio margin. They actually gave me a direct phone number that I can call their derivative team anytime I want. But there are a lot of good brokers out there. I think, TD Ameritrade is going to be pulled into Charles Schwab, and Thinkorswim's a great trading platform. So I think it really depends on what type of trading you're doing. There's a lot of good ones out there. Tastyworks is good. Independent was it Brokers? And that's good. Interactive Brokers is good. I'm with Charles Schwab. I don't know if I mentioned that. That's who because I like the fact that their customer service is, I can get a hold of them any time of the day, and that for me goes a long way.
Yeah, peace of mind.
In a previous life, I worked for Schwab 20-something years ago. Sandy, a question for you probably. Don't you need margin for a spread?
You do. You do need a margin account for a spread. And again, it is interesting that they make you do that, even though it's risk defined. So as soon as you get into the spread, what your max loss could be, as well as what your potential gain is. So you do need it. It's not difficult to get. And within your account, I always suggest that regardless of what your balance is in total, you can get both a cash account and a margin account so that you're able to do both. And you can transfer the funds in between those accounts, like an inter-department kind of transfer. And it only takes a minute if you're on TDA and you want to transfer money from one account to another. You just click the button and that money is now in your cash account, and you can, make your day trades or whatever you want to do with it.
Sandy, did I hear you right that where you're at, you can't do spreads in a retirement account? Because I can.
Oh, no. Just that if you wanted to do spreads, you needed a margin account.
Oh, gotcha. Yeah.
And it's interesting that they, I don't know. I always found that interesting that they make, you could go and buy calls and puts, but you can't.
Yeah, I know.
Right? It's
Good
crazy.
Point.
It's so bizarre. But you can do it. Just have a cash account and a margin account, link them together, and you can do it right from your platform and have the ability to do both if you didn't have a balance of over $25,000.
Okay, what about some tax advantage? You're in mostly tax advantaged accounts, Richie?
Yes, I am, unfortunately. I have, that's one of the reasons why I got to wait till I'm 59 and a half to have full access to my nest egg. But I would say I'm right around 75% IRAs now and 25% after tax money. And but I have a fairly large account, so that 25% is certainly enough for me to generate income to live on. But I started, in 1990 putting away. I think that's the key is to be consistent and start putting away, but not wanting to wish your life away. I did that a little too much.
Understand. And then you have it some in a Roth as well?
The Fed Reserve offered a Roth 401k, which was a blessing because my income level wasn't where I could put into a Roth IRA. But if your employer offers a Roth 401k, you can actually contribute to that regardless of what your salary is. So I was able to roll over a Roth 401k, and it's now a Roth IRA, and it's been a blessing. And I typically include the REITs in there. I have Realty Income, which is symbol O, and you'll want to put higher income in REIT type investments in a Roth. At least that's my opinion.
I really appreciate you saying that without me having to pay you, because one of the things Sandy gets tired of hearing me say is you can't be too healthy or have too much cash tax-free income.
I know, he's always bugging me. I'm like, I'm just using my regular cash. He's like, why? That's a silly decision. Why are you doing that? He's absolutely right. He's so true. Why aren't I using my 401s and my tax deferred accounts? I never even thought about it, to be quite honest with you.
Andy, after listening to this show today, you're going to really make some changes.
Oh yes, I have to.
And I would just add real quick, I'm sorry, probably my most successful wheel trade is in my Roth IRA, and it's symbol O. And what's nice about it is you don't have to worry about taxes. I can do the covered calls, then I can sell a put, I get back. And I've literally been doing that, and I think my overall annual return on that right now is 17%. And you don't have to worry about taxes. So
that's incredible.
Yep.
Well, Richie, this has been great. Jay, any last questions? And we'll get this ball rolling and start creating channels of information as well as trade alerts for this type of trade strategies. And we look forward to the feedback, what you guys think within a couple weeks or so. Let us know how you're doing, and we'll just continue this.
Yeah, we've got about 3 minutes left here, and a couple people are typing. Richie, someone asked if you're on Twitter.
I am on Twitter.
Go ahead and tell us your login or
handle.
Is it? Let's see. It's Richie. Is it Richie Thorne at Thorne Richie? I guess that's what that is. I think if you Google Richie Thorne, it'll come up. I'm also on LinkedIn.
Okay. All right. Well, you'll have some more people following you now on Twitter. I can guarantee.
I'm more active. Yeah, that's great. I'm more active probably on LinkedIn, but no, that's good.
That's great. And if you don't mind, I'll send you an invitation to connect.
Great.
All right,
well,
Sandy, I'll let you wrap it up.
Thank you, Jay. Thank you, Richie. Look forward to working with you, and and we'll definitely get together and maybe map out a schedule for some more education and get your channels up and running and see how this goes.
Thank you for having me.
All right. I think we have some applause here at the end, so thank you again.
Thank you.
Thank you.
Thanks, Richie. I'll see you on the other side.